Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recent action continues, more or less, to be captured within the two explosive days range back in late February, between 1579 and 1759. Since then, despite an initial but now defunct bull channel, the market edged lower in a 2 steps up and 3 steps down action, such that at the start of April we saw a test and breach of the support band 1579 to 1571, and prices briefly tested down to 1560. Going forward, for the moment, I still maintain the longer term patterns I'd seen over the middle and end of last year and going into this year. They're all bullish and they consist of the rounded bottom, a large cup with handle pattern, and a scallop pattern. They seem to be still running there. To be honest, there's been a bit of a disappointment to see no real attempt at trying for any of these longer term patterns targets topside. But on these there is still time. You see, the rounding bottom still has a primary topside target in the 1983 area, which is off the top of my daily chart right now. The next one is the large cup with handle pattern, which has a primary target in the 1910 area. Once again, this is off the top of my daily chart. Finally, the scallop pattern, or to be accurate, the ascending scallop pattern, this is a primary target in the 1836 area, until recently off the top of my daily chart. An interesting one I have the least confidence in, even if it is the nearest. You can see it labeled as target X with a question mark above. These are all, as I've repeatedly stressed, way out there. But as we've seen plenty in recent times, lots of things that are way out there can suddenly happen. Going back to nearer term action, what I've seen over the last 5 weeks or so has not been a definitive move higher, nor have we seen prices turning back down sharply. What we've seen instead is a somewhat sideways action. This action still may be in the form of a long time in construction bearish pattern, it could still be that. Or it may be in the form of the more recent idea of a rectangle pattern. At this moment I'm not sure which, if either, is undergoing construction right now. The one thing this past week, which is unique in recent times, the one thing I've seen this past week which is unique in recent times is that the market, just by going sideways, has dropped below the rising medium moving average, currently 1630. This is the first time the market has crossed the medium moving average since December 2021. And this is the first time the market has gone below the medium moving average, so not crossed but literally gone below, since June last year. Hence, I suspect we might see a possible reaction to just that action. There's one other possibility. We may end up with a bow tie formation of the short moving average, currently 1640, short medium moving average, currently 1642, and the medium moving average. I would like to finish off, that's still not there, but wash off. We'll just keep an eye out for that one because they're coming awfully close together. I'd like to finish off with something I'd originally said in my annual review of soybeans made at the very start of 2022. Back then I was only looking at longer term charts, and I quote, "One other idea I would like to, let's say, provisionally float by you, it is way too early on this, but it should be worth considering, is to look at the whole of the 2020 to date action as a possible bullish halfway hesitation. In which case we might, I say might, with due deference here, we might have a possible target X topside in the 20 and a quarter area. I'll just repeat that, in the 20 and a quarter area. This is way up off the top of my long-term chart, and it might sound ridiculous now. Indeed, it does sound ridiculous, but it is what I see, and I'd rather say it and maybe look ludicrous, even laughable now, than be silent and be confirmed as an idiot who should have said something should it come about. Anyway, this is a multi-month and likely a multi-year potential target X, so there ought to be plenty of time. Plus, it will all depend on what the market does when and if it meets the 2021 high at 1667 and the 2012 high at 1789. This specific bigger picture idea done at the start of 2022 is still there despite the recent daily actions. Chicago soybean meal. Okay, so I've spoken at length about the topping action over late January, late April that turned out to be a head and shoulders top with a split head. It's not a perfect pattern, but it's a workmanlike head and shoulders top. 7 weeks ago, the market breached and closed below the neckline, currently 449.5. and triggered the pattern, which subsequently fulfilled all the opportunities, primary and secondary, on the downside. Now, a significant part of the erosion of the move lower has been, and is what we are still seeing, the market's reluctance to test the slowly rising long moving average below. That's currently at 398.10, and that's as well as the 50% Fibonacci of the August 21 to March 22 move at 386.80. Even the nearer 50% Fibonacci line at 400.50 of the October 21 to March 22 move, whilst being tested, has not been broken. Has been breached but not been broken. Prices have recovered back up twice, and it looks like possibly a third time now, over May and June, though admittedly each time was a smaller recovery than the previous time. Interestingly, the larger of the last two times, the move back down was with a combined daily key reversal down 3 Mondays ago and a weekly key reversal 2 weeks ago. Even then, this did not manage to break through the 50% Fibonacci lines and the long moving average. This week prices managed to dip down to kiss the long moving average. The first time this has happened since December of last year. That's where I left the same two possible future market actions that may be in offing, and which I described here last week. They are, and I quote, one is an immediate market pattern, and the second is a longer term pattern. The immediate market pattern is to possibly regard the market channeling in between the long moving average below and the congestion at 433.5 above. The second possible longer term pattern, should it come about, may be strategically massive. It is to regard the whole action since mid-December 2021 to date as a huge head and shoulders pattern. This head and shoulders pattern has the original February to April action head and shoulders top as a crown on the large head pattern. Now, before you start jumping to conclusions, yes, head and shoulders patterns, as we have seen here recently, are usually regarded as topping patterns. And it is an important but they can also be a possible continuation pattern higher. And just because the last head and shoulders pattern seen here was a topping action does not mean that this larger one will be. Or in other words, post hoc ergo propter hoc. And I think it's really important to stress that point. That's the end of the quote. Until these markets work their way through these patterns and choose which is which, then we will stay here. Chicago soybean oil. The market made a new all-time high at the end of April. However, the peak on the last day of April was made with a bearish pattern, a bearish engulfing pattern, if only just, and we subsequently saw prices fall down, even gapping lower down to just after mid-May, when they seemingly stabilized. What caused this stabilization? Well, it was a combination. The 50% Fibonacci line, the February to April move at 75.24, perhaps more importantly, the rising short medium moving average, currently 78.15. Why was this important? Well, if you look at the previous time the market tested the short medium moving average back at the very start of April, and you can see how important it was then in turning the market back up. Hence, I suggested treating the short medium moving average with great care in any future dealings. What was additionally special about this turnaround back up was that 2 weeks ago we had a weekly key reversal up here at the exact same time that soybean meal had a weekly key reversal down. You may read a lot into that, I think. I will now step back a bit and remind you of how back in April we had a monthly key reversal up. This is because part of a longer term this was part of a longer term pattern, but it's still very, very noteworthy. So I've had both a monthly and now subsequently weekly key reversal up. This said a lot about the market, or you might have thought so. Last week prices did move higher at the start, but by midweek last week they had turned back down with a bearish belt hold pattern. Now, that's one of the most consistently daily bearish patterns that you can find, and we have dropped lower ever since. Below the short medium moving average, and today below the 50% Fibonacci line at 75.24. We're now down to testing the combination of the three-pointer mid-January today uptrend, currently at 74.44, and the rising medium moving average, currently 74.27. Now, so far these two have held, but below these we only have the previous all-time high back in 2008 at 72.67 before we're back testing the 70 even area. I have a concern that the late April to day action may contain two possible bearish halfway hesitation patterns. They're not good looking patterns, but they are there. The one from mid-May gives a possible target below in the low 7,300 area, or 73 cents area. This one is doable, but I've chosen as yet not to mark it. The second, looking from the late April high, is down to the 70 even area and ties in with some of my earlier comments. It all very much depends now if the combination of the uptrend and the rising medium moving average will hold. If not, then we are on a different game. Thank you for listening. This short weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. Here comes the final bit.